If you're receiving Social Security right now, stop what you're doing. Because something changed this week that most retirees have absolutely no idea about. And if you don't find out in time, it could cost you hundreds of dollars every single month after month, permanently. I'm not talking about a rumor. I'm not talking about some political promise. I'm talking about real changes, already signed, already in effect, that will affect how your benefit is calculated, when it gets paid, and in some cases, whether it keeps coming at all. And here's what's making people furious. The SSA, the Social Security Administration, is not sending letters about this. It's not going to show up on the evening news. Your neighbor doesn't know. Your kids probably don't know either. But by the time this video is over, you will know exactly what changed, what it means for your check, and the one action you need to take this week. Watch until the end, because this is about your money. Let's start with the facts. No panic, just the truth. In 2026, 3 major changes were quietly pushed through that directly affect Social Security recipients. If you're between age 62 and your full retirement age, your FRA, and you're still working while collecting benefits, you need to pay very close attention here. The earnings test is a rule that says, if you're receiving benefits before your FRA and you're still earning money from work, the SSA may reduce your check depending on how much you earn above a certain limit. For 2026, that limit was revised, and it affects people in very different ways. For some, the new threshold is higher, which means more freedom to work without a penalty. For others, especially those working part-time while collecting early, it means a surprise deduction they were not prepared for. But how does it actually work? Let me explain it clearly, because a lot of people don't understand the mechanics and end up getting blindsided. Here's how it breaks down. For every $2 you earn above the annual limit, the SSA withholds $1 from your benefit. So if the limit is $22,320 for 2026, and you earn $24,320, that's $2,000 over the limit. The SSA withholds $1,000 from your benefits over the course of the year. Now, in the specific year you reach your FRA, the rules get a little more forgiving. During that year only, for every $3 you earn above a higher limit, the SSA withholds just $1. It's a gentler transition. And once you're past your FRA, the earnings test disappears completely. You can work and earn as much as you want with zero reduction to your benefit. So the question you need to ask yourself right now is, am I inside the earnings test window? What is my FRA? Am I still working? How much am I earning? If you're between 62 and 66 or 67, depending on your birth year, and you're collecting benefits and working, you are the group most exposed to the 2026 change. The COLA, cost of living adjustment, for 2026 came in at 2.5%. On paper, that sounds decent. But here's the problem. Nobody is explaining properly. At the same time, your benefit went up 2.5%. The Medicare Part B premium also went up. And for many retirees, the Medicare increase canceled out or even exceeded the COLA increase. That means a lot of people are actually taking home less money in 2026 than they did in 2025. Let me give you a concrete example. If your gross benefit was $1,500 in 2025, the 2.5% COLA added $3,750. Great, right? But if your Medicare Part B premium went up $15, $20 or more, your real gain dropped to less than half of that. And after taxes and other deductions, you could actually be coming out behind. How do you check? Look for your SSA 1099 form, which you receive every year. It shows your gross benefit amount and your Medicare deductions. Compare it to last year's form. The number left over after all deductions, that's your real benefit. Also, check the annual Medicare premium notice the SSA sends toward the end of each year. It spells out exactly how much will be deducted. If you can't find that notice, log in at ssa.gov or call the SSA directly. We'll talk more about that in the action plan section. This one is the most dangerous, and the one getting the least media coverage. The SSA has reactivated aggressive overpayment recovery. That means if you were overpaid at any point in the last several years, even if the mistake was not your fault, the SSA can now withhold up to 100% of your monthly check until that debt is fully recovered. 100%. Your check goes to zero. And it has already happened to thousands of people. Let me say that again because it's that serious. If the SSA miscalculated your benefit 2 or 3 years ago and paid you more than they should have, without you even knowing it, you could receive a notice today saying you owe $5,000, $10,000, $20,000, and they have the legal right to stop your check completely until it's paid back. Who gets hit hardest? SSDI recipients, people on Social Security disability insurance, have been the most affected. Many had their benefits miscalculated during the pandemic, and now, years later, the SSA is coming back for that money. But this is not limited to SSDI. Anyone receiving Social Security could be exposed. And here is the most critical detail. You have 60 days to contest an overpayment notice or request a waiver. After 60 days, that right is gone. The SSA can begin withholding your payment immediately without further discussion. So if you have any SSA mail sitting unopened from the past 60 days, open it right now. Not after the video, right now. Let's break this down by group because the impact is very different depending on your situation. You are the most exposed group of all. The earnings test hits you if you're still working. The reduced COLA hits you. And if you started collecting before your FRA, each year of early claiming permanently reduced your monthly benefit. That's why if you're considering starting to collect early, you need to understand the break-even analysis. We'll cover that in detail in the action plan section. The overpayment recovery rule hits this group the hardest. Many received different amounts during the pandemic due to temporary rule changes. The SSA is now reviewing those records and sending collection notices. Some letters are demanding $10,000, $15,000, $20,000 or more. And the window to contest is only 60 days. If you're an SSDI recipient, check your mail immediately. There's a strategy that most widows and widowers never learn about until it's too late. You may be entitled to 2 types of benefits: the survivor benefit based on your deceased spouse's earnings record, and the retirement benefit based on your own work history. And here's the secret the SSA will never call you to explain. You can receive one benefit now and switch to the other one later. This is called the switching strategy. For example, if you're entitled to a survivor benefit and also to your own retirement benefit, you might start with the survivor benefit early to have income coming in now, and then switch to your own retirement benefit later once it has had more time to grow. Remember, every year you wait to claim your own retirement benefit after age 62 increases its value by roughly 5% to 8% per year. So if you can live off the survivor benefit now and let your own retirement benefit grow until age 70, you can significantly maximize your total lifetime income. With the 2026 recalculations, many widows and widowers who switched benefits at the wrong time are permanently leaving money on the table. If you're in this situation, it is absolutely worth reviewing. The spousal benefit formula was quietly adjusted. The spousal benefit allows you to receive up to 50% of your spouse's full retirement benefit amount, based on their earnings record, not yours. And the SSA is not going to call you to tell you this is an option. You have to ask. With the 2026 recalculation, the percentage some spouses receive may have changed, and most couples have absolutely no idea. This group has a specific problem that most people only discover when it's already too late: the WEP and the GPO. The WEP, windfall elimination provision, and the GPO, government pension offset, are two rules that can dramatically reduce Social Security benefits for people who also receive a government pension from a job that was not covered by Social Security. Teachers, police officers, firefighters, state employees in states like California, Texas, and Ohio, many of these workers paid into two separate systems, and the result can be a reduction of 30%, 40%, or even more than 50% of their expected Social Security benefit. The good news in 2026, there is real momentum in Congress to eliminate or reform the WEP and GPO. Bipartisan support has been growing steadily. If you fall into this group, keep a close eye on the latest updates, because a change to this law could mean hundreds of dollars more per month for you. Let me be straight with you. The SSA has a website. They have a phone number. They have thousands of employees. And yet, the most important information about how your benefit is calculated and what your rights actually are is buried so deep in bureaucratic language that most retirees never find it. They know. They just don't call you to tell you. Here are 3 things that are written into law, but that the SSA will not proactively communicate to you. If you believe your benefit was calculated incorrectly, you have the right to request a reconsideration. It's in the law. The SSA doesn't advertise it, but people contest and win these appeals every single day. The process starts with a review of your earnings history. Incorrect 0 years, missing work periods, dates that don't match your actual employment record. All of that can be quietly reducing your monthly check right now without you knowing. If you worked and paid Social Security taxes, but your own benefit is lower than your spouse's, you may never need to use your own record at all. You can claim a spousal benefit, up to 50% of your spouse's full retirement benefit amount. No complicated eligibility hoops, but the SSA will not tell you to make the switch. You have to ask. And here's the part that surprises most people. Claiming the spousal benefit does not reduce your spouse's benefit by a single dollar. Both payments are completely independent of each other. A lot of people don't realize Social Security can be taxed at all. Others know it can be, but don't understand exactly how it works. The taxation depends on a number called your combined income, and that number is not simply your Social Security benefit. Here's how combined income is calculated. Take your adjusted gross income, which includes wages, pension income, dividends, and retirement account distributions, plus any tax-exempt interest you receive, plus half of your annual Social Security benefit. Add those 3 things together. That total is your combined income. If that total stays below $25,000 for single filers or $32,000 for married couples filing jointly, you pay no federal tax on your Social Security benefit. If your combined income falls between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 as a married couple, then up to 50% of your benefit may be taxable. If your combined income exceeds those upper limits, up to 85% of your benefit may be subject to federal income tax. Now, and this is important, that does not mean you pay an 85% tax rate. It means that up to 85% of your benefit gets folded into your taxable income, and you pay your regular income tax rate on that portion. This calculation catches a lot of people completely off guard, especially those who have investment income, a private employer pension, rental income, or regular 401k withdrawals on top of their Social Security. Now that you know what changed, let's talk about what you can actually do and starting today. I know this sounds basic, but over 40% of Social Security recipients have never logged in to verify how their benefit was calculated, and errors in your SSA record, years incorrectly listed as 0, missing work periods, wrong dates, are directly reducing your monthly check right now. Go to ssa.gov, create or log into your My Social Security account, and download your earnings history. Look specifically for years that show zero or an unusually low number that shouldn't be zero. Periods when you clearly worked but no earnings appear. Anything that doesn't line up with your own tax records from those years. Any error you find can be contested, and if the error is confirmed, your benefit can be recalculated upward. Do not ignore SSA correspondence, not even letters that look like routine benefit statements. Overpayment notices frequently arrive disguised as standard benefit communications. If the letter contains the words overpayment, recovery, adjustment, or waiver, you have exactly 60 days to act. You can request a waiver if you cannot afford to repay, if the overpayment was not your fault, or if repaying it would cause serious financial hardship. You can also file a formal appeal if you disagree with the amount they're claiming. But that right disappears after 60 days. After that, the SSA can begin withholding your check immediately. This is a step most people have never taken, and really should. Start with your gross Social Security benefit. Subtract your Medicare Part B premium. If you have Medicare Part D, the prescription drug plan, subtract that too. And if your combined income exceeds the thresholds we talked about, factor in your estimated federal income tax. What's left after all of that is your real net benefit, the money that actually lands in your bank account. Compare it to what you were receiving in 2025. If the number went down, you need to know why, and you may have options available to you. One of the main reasons for the drop in 2026 is the Medicare Part B increase eating into the COLA gains. If that's your situation, it's worth checking whether you qualify for the Medicare Low-Income Subsidy, also known as Extra Help, which can significantly reduce your out-of-pocket Medicare costs. This is the step most people skip, and it can cost a fortune over a lifetime. The break-even analysis answers this question. If I wait longer to start collecting, at what age does the larger monthly benefit finally surpass the total amount I would have collected by starting earlier? Here's the core math. Every year you wait past age 62 increases your monthly benefit by roughly 5% to 8% per year. If you hold off until age 70, the maximum delay advantage, your benefit could be up to 76% higher than if you had started at 62. But there is a break-even point, typically somewhere between ages 78 and 82, where the accumulated value of the larger benefit finally surpasses all the money you would have collected by starting sooner. If you're in good health with a family history of longevity, waiting often makes financial sense. If your health is already compromised, or you genuinely need the income today, starting earlier may be the right decision for your situation. For widows and widowers, the analysis gets even more nuanced. Because it involves two separate benefits, the survivor benefit and your own retirement benefit, and the switching strategy we discussed earlier in this video. There's no single right answer for everyone, but everyone should run this calculation before locking in their decision. Let me be honest about something that genuinely makes me angry, and that I know makes you angry too. The SSA has a massive infrastructure. They have the resources. They have the legal obligation to administer one of the largest social programs in the history of this country. And yet, the most important information about how your benefit actually works and what your rights are is buried in technical manuals written in bureaucratic language that almost no one can follow. Most retirees only discover they could have received more money when it's already too late to do anything about it. Changes that affect hundreds of dollars per month arrive without a warning letter. Rights that are written directly into law never show up in any notice. And the result? People who worked their entire lives, who paid decades of payroll taxes specifically to earn this retirement security, end up losing money simply because nobody ever explained to them how the system actually works. That is not right, and it's exactly why videos like this one exist. So let's bring it all together. In 2026, 3 real changes are directly affecting Social Security. 1. The earnings test threshold was revised, affecting anyone between age 62 and their full retirement age who is still working. For every $2 earned above the limit, $1 is withheld from your benefit. 2. The 2.5% COLA is being partially or fully wiped out by the Medicare Part B premium increase for many retirees. Your real net benefit may have actually gone down this year. 3. The SSA has reactivated aggressive overpayment recovery and can now withhold up to 100% of your monthly check. You have 60 days to contest any notice you receive. The most vulnerable groups are early retirees, SSDI recipients, widows and widowers who don't know the switching strategy, married couples with spousal benefits, and public employees affected by the WEP and GPO. What the SSA will never call you to say, that you can appeal your benefit calculation at any time, that you may qualify to collect up to 50% of your spouse's benefit, that whether your benefit gets taxed depends on your combined income, not just the benefit itself, and that the WEP and GPO may be on the verge of elimination in 2026. Your homework for this week: log into ssa.gov and pull your earnings history. Open any SSA mail you've been putting off. Calculate your real 2026 net benefit, gross minus Medicare minus taxes. Run the break-even analysis if you haven't made your claiming decision yet. Share this video with someone who receives Social Security. They need to hear this. Your Social Security check is not guaranteed to stay the same. The rules are changing, and the government is not going to warn you. The people who get hurt are the ones who wait. Don't wait. That money is yours. You earned every dollar of it. If this video helped you, hit subscribe and ring that bell. Every week, I bring you the real Social Security news that the mainstream media keeps missing. And drop a comment below. Which of these 3 changes affects you the most? I read every single one. Take care of yourselves and your check. See you in the next video.